Okay, I guess now we are on live. We are online properly. Yeah, I think so. Hi everyone, very good afternoon. Hope all of you are studying well, all of you are doing well. So exam dates just announced yesterday. Exam dates just announced yesterday. It's a relief of 14 days as such. Your foundation inter final exams. You have a slightly more time that has been given to you, and as I've been doing on the Unacademy's channel, I'm coming out with these YouTube live lectures for CA final paper number 7, talking about all the amendments that have been introduced by the Finance Act 2021. We already have two batches going on, one in the morning, one in the evening on the Unacademy platform for May exam and November exam. So in these YouTube lectures, basically I try to cover the amendments so that you know and just watch these videos and revise your amendments one day before the exam during your revisions. Hi Nabil, hi beta. So the agenda for today is to discuss the amendments of TDS and TCS. This is a chapter which is regularly part of your question paper, always. You can be rest assured that TDS and TCS, there is definitely a question asked. In fact, related to amendments, there is surely one or two adjustment in the question based on TDS TCS. This is true not only for CA final, this is also true for CA inter question papers as well. It's a chapter, it's a concept, it's a chapter that even the government is attaching a lot of importance, and so institute also obviously is going to ask you questions on a repetitive basis. The weightage is a standard 6 to 8 marks weightage, and you can definitely be sure that you will get a question based on TDS and TCS. It will be a case study type of question. You'll have to give your theory answer. Some of them are based on case laws, some of them are based on amendments. So, what has Finance Act 2021 done? Broadly speaking, some important amendments that have been introduced are like this. There are two sections that are introduced: TDS rates and TCS rates. They are targeting non-filers of return of income. Very interesting as an amendment. Numerically, you can get it's basically a numeric type of amendment. So you can expect MCQs as well. You can expect descriptive questions too. Then there is a very small section 194p inserted, which is kind of easy, nothing great. Then there is a very, I would say, controversial, at the same time, some may say unnecessary amendment as 194q. TDS and TCS chapters. Broadly, in the Finance Act 2021, have these two amendments. One for non-filing of return, and the second one for that purchase and sale of goods. Chalo, let's pick up what these things are. Basically, if you are somebody who has not filed a return, then your TDS rates and TCS rates and TDS rates have increased. A new section is introduced, 206AB. This is for deduction of tax at source. If you are somebody who is not filing a return. What do you mean by somebody who is not filing a return? Subsection 3 clarifies that. Subsection 3 says that you are a person who has not filed the returns of income for both of the two assessment years relevant to the two previous years immediately prior to the previous year, in which tax is required to be deducted at source. So, as an example, if we are talking about our current year, previous year 21-22, and we are going to check that TDS is to be deducted in this year, then what should be the rate of TDS? Now we have to check 2 preceding years, which means I am talking about previous year 1920 and previous year 2021. For these 2 years, both the years, return of income is not filed by the assessee, by the person, so that assessee, that person, now in my discussion, he is going to be the payee. He is going to be the person who is going to receive the money, and he will be affected, or rather I should say adversely affected by this concept. Now we are told, payer, when you will deduct tax from the gross amount, your TDS rate will not be the rate given by the section. Your TDS rate will be the rate that section 206AB prescribes. And obviously, 206AB has prescribed a high rate of TDS, so that this receiver who has not filed a return of income, in the section, this receiver is called as a specified person. This receiver who has not filed a return kind of gets penalized, that now this person will have to ensure that at least for this current year, that is 21-22, he files a return. He suffers higher TDS. Higher the TDS, more tax will be deducted at source and deposited with the government. That means there may arise a possibility that this assessee will have a situation of refund. So we are in a way forcing him to file a return, so that if he files a return for the current year 21-22, he will be able to claim a refund, and he will be able to ensure that in the next year this section is not attracted. The drafting done by the lawmakers is, you have not filed a return for both of the 2 assessment years. So if you do not file a return of income for both the past 2 years, then this section gets attracted. And what is this section saying? Tax shall be deducted at the higher of the following rates. 1, twice the rate specified in the relevant provision, twice the rate specified as per the budget rates in force, or 5%, whichever is higher. So if we are talking about, let us say, TDS done on interest, section number 193, for example, says the TDS is at 10%. But if 206AB will get attracted, then it will be twice the rate, 20% or 5%, whichever is higher. So tax will be deducted at source at the rate of 20%. This means that what ideally should have been 100 minus 10, 90 rupees ka check, becomes 100 minus 20, 80 rupees ka check. Thereby the receiver receives less money, and now he has to compulsorily file that return, at least for the current year, to recover that amount of TDS in the form of refund. Say for example, we are talking about TDS on contractor payments. If the receiver is an individual, then the normal TDS rate, section number 194C, is 1%. But if 206AB gets attracted, then it is twice the rate, 2% or 5%, whichever is higher, 5%. So earlier, from a payment of, let's say, 2 lakh rupees, tax used to be deducted at source of 2000. Now that straight away becomes 10,000. Not only does it affect the cash inflow, but it also results into more TDS, resulting into a refund. Now this section will ensure that if you want to get back your money which has gone to the government in the form of TDS, you got to file a return of income at least for this year, so that next year this section does not get attracted. 206AB also clarifies that for section 192, for section 192A, for 194B, for 194BB, and for 194LBC and 194N, this section will not apply. This provision will not apply. So then it means tax will be deducted at source for them at normal rates only. Like for example, when salary is paid, tax is deducted at source according to the slab rates, and then the yearly tax is divided over the period of service. Now, if this employee has not filed his return of income for the preceding 2 years, you will not take the TDS amount and multiply it by 2. No. Then your tax deducted at source will continue to be the TDS as per section 192 only. 206AB, the new section created, does not apply. All other provisions of this chapter of TDS, chapter number 12B, chapter number 17B, all other sections of TDS except for these highlighted, 206AB will apply. Then another interesting thing that the lawmakers have drafted is that they have thought, what if 206AB and 206AA both apply? What if the person is a non-filer of return of income for the past 2 years, as well as in the current year does not submit his permanent account number? Does not submit his permanent account number. So if you don't submit your permanent account number, 206AA will get attracted. What does 206AA say? See, 206AA says that if you don't submit your permanent account number, your tax will be deducted at the rate given in the section or 20%, whichever is higher. So what if there are these two type of defaults made? For the past 2 years, you have not filed your return of income for both the years, and in the current year, you do not submit your permanent account number to the payer. Then find out the TDS rate given by 206AB, applying this formula, twice the rate or 5%, whichever is higher. Compare it with the rate that is decided as per 206AA, the original rate given in the section, or 20%, whichever is higher. And then compare the higher of these two rates. This will be the final rate of TDS. So this means multiple examples can be thought of, but the bottom line is very simple. If you are somebody who has filed a return of income for both the years, who has filed return of income for both the years, 206AB does not get attracted. And in the current year, to the deductor, to the payer, you submit your permanent account number also. Then 206AA is also not attracted. Then TDS will be done at the normal rate applicable, whatever is the rate applicable as per the section. Situation number 1, an ideal situation. The receiver submits his return of income for the past 2 years. He submits his permanent account number. He's complying with the law. He will be subjected to TDS at the normal rate. Then, if there is an assessee who refuses to give his permanent account number to the payer, now tax will be deducted at source as per 206AA, which says take the original rate, compare it with 20%, whichever is higher of the two. But if you also commit this fault of not filing a return of income for the past 2 years, then 206AB will also come into picture. So either it is 206AB ka rate or 206AA ka rate, whichever is higher of the two, will be the TDS that will be finally deducted at source. Subsection 3. We didn't read it fully. I'll just read it once so that we can interpret that properly. For the purposes of this section, specified person means a person who has not filed the returns of income for both of the assessment years, relevant to the 2 previous years, immediately prior to the previous year in which tax is required to be deducted, for which the time limit of filing the return of income under section 139(1) has expired. So if you have not filed a return of income and your 139(1) time limit has expired, then you will be covered by 206AB. But it also says one more thing. The aggregate of tax deducted at source and tax collected at source, aggregate, in his case, is rupees 50,000 or more in each of these 2 previous years. So we are saying that there are 2 conditions actually. For 206AB to apply, there are actually 2 conditions that I got to satisfy. 1, not filed a return of income for both the years as per section 139(1). Second, the amount of TDS done for this person, the amount of TCS done for this person exceeds 50,000 rupees in each of the 2 years, which means here also in simple terms I can write down, in both the years, the amount of TDS and TCS exceeds 50,000. Now for 206AB to get attracted, these are my 2 conditions. And if these conditions get satisfied, then 206AB gets attracted, which will say twice the original rate or 5%, whichever is high. Then the section also goes ahead and clarifies one thing. The definition of specified person shall not include a non-resident who does not have a permanent establishment in India. So if a non-resident does not have a permanent establishment in India, there are so many provisions in the Income Tax Act that we are aware that uh, their their business income will not be subject to tax because there is no permanent establishment. They will be covered by some concessional tax rates. They will not be required to file their return of income because TDS will be deducted at the concessional rates only. So then you have to be logical enough, na? In the preceding 2 years, you gave relief. The Income Tax Act gave relief to the non-residents from filing of return. One example is, maybe you guys would have studied it, maybe you guys know this. If you are covered by section number 115A, then your tax rate as a non-resident on those incomes is only 5%. Let's put it up here. And correspondingly, under 194 LC, TDS will be done at the rate of 5%. And 115A categorically says that you will get a relief from filing of return of income if the incomes that you earn, dividend, interest, royalty, fees for technical services, these are the only incomes that you are earning in India, and tax is payable under 115A and TDS has been done under 194 LC. Now, as a section of Income Tax Act, if you are giving a relief from filing return of income to the non-resident, now it would be wrong that for the past 2 years, the non-resident who did not file his return gets attracted by this section 206AB in the current year. And now you tell the non-resident, okay, we will deduct TDS at twice the rate. That is wrong because he's not a defaulter. He has not filed his return. He's a non-filer because he was not supposed to file a return. This section is intended to target those people, those assessees who are required to file a return but yet have not filed the return. Now they will suffer by way of double TDS. As a non-resident who does not have a permanent establishment in India, there are concessional tax rates created for them, concessional TDS rates created for them, relief is given from filing return. So then this section 206AB, this newly inserted section, will not apply for them. Then the explanation given to in the section clarifies what do you mean by permanent establishment. This is the standard definition of permanent establishment. There's nothing difficult. So this section 206AB is for TDS. An identical section has been created for tax collected at source also. Collection of tax at source, TCS. If you are a non-filer of income tax return, what do I mean when I say tax collected at source? So there is one thing that makes it very simple. When you are talking about tax collected at source, the one who receives the money is the person responsible. Sorry, the one who receives the money is the person responsible to collect the tax from the payer of money. So it will be that the payer of money will pay the amount that he is anyway supposed to pay plus tax collected at source. Section 206C. Certain goods are sold, motor car is sold, overseas remittances are made, certain goods are sold which are not covered by the preceding all the other provisions of TCS. They are covered. They are also covered by TCS under a separate subsection. So when you are collecting tax at source, TCS rate is given to you by section 206C. But for non-filers, we will also have to take into account the new section 206CCA. Of course, now when you're talking about non-filers, who are the persons who are the non-filers targeted? These guys, the one who pay the money. If they are non-filers of return of income, they are now covered by this new section 206 CCA. What is the definition saying? Specified person means a person who has not filed the returns for both the two assessment years, same drafting given, and the aggregate of tax deducted and tax collected at source in his case is 50,000 rupees or more in each of the 2 years. I'll just clarify one thing, greater than or equal to 50,000. Time limit under section 139(1) has expired and you have not filed a return of income for both the two assessment years and your TDS plus TCS amount is greater than or equal to 50,000, then you are covered by 206 CCA, which says twice the rate given in the TCS section or at the rate of 5%. If you just glance through the new section 206AB, it says twice the TDS rate or 5%. 206 CCA says twice the TCS rate or 5%. Like we have 206 AA, which says you are required to furnish a permanent account number. Similarly, we also have a provision 206 CC, requirement to furnish permanent account number. You are supposed to give your permanent account number, failing which tax will be collected at source at twice the rate or 5%, whichever is higher. So your 206 CC and 206 CCA basically are giving you the same provision, twice the rate or at 5%, whichever is higher. If you make a comparison, maybe if I draw a comparative thing before you, it might make it more clear that if I am talking about the situation of tax deducted at source, you do not submit your permanent account number 206 AA. If you do not submit your permanent account number, then your rate is the rate given in the section. That means the original rate in the section or %, whichever is higher. If you do not submit your if you do not file return of income, then 206 AB comes into picture, and 206 AB says twice the original rate or 5%, whichever is higher. So both the formulas are different when it comes to TDS. When it comes to TDS, the two formulas are different. But if you read the TCS concept, tax collected at source, do not give your permanent account number, 206 CC comes into picture, and 206 CC says twice the original rate or 5%, whichever is higher. But if you are also an assessee who has not submitted your return of income for the past 2 years, then the new section 206 CCA comes into play. And 206 CCA is also giving you actually the same formula, twice the rate specified in the relevant provision or at the rate of 5%. TCS is actually quite easy to remember. Twice the rate or 5%, whichever is higher of the two. That means if you make a default in filing your return of income for the past 2 years, or if you don't submit your permanent account number, either ways, your tax collected at source rate, TCS rate, will be the same rate. Which means if both the defaults happen, if the provisions of 206 CC are applicable to the person, in addition to the provisions of this section, tax shall be collected at higher of the two rates as provided in this section and as provided in 206 CC. But then 206 CC is also giving you the same formula that the new section CCA is giving you. So at the end, if you try to apply both the provisions, effectively the rate will remain the same because the formula given is the same. It will make a difference in tax deducted at source, but in tax collected at source, it's basically going to be the same. Again, the same exception provided that if you are a non-resident who does not have a permanent establishment in India, then this section will not apply. Non-filing of return of income will not be counted as a default for you, and you'll be exempted from the applicability of this section. You don't have to suffer this high rate of TCS. Chalo. I've printed some examples where I have tried to apply 206 AA, 206 AB, one of the two, both of them. So you can go through these examples. I'll be sharing a Google Drive link of this PDF that I'm currently using. So you can go through the examples. You can see how both the sections are becoming applicable. Chalo. Moving ahead. Okay. This is a very simple section, 194P. It's a kind of a relief section that has been given by the Income Tax Act. Just give me a second, I'll put up the link. This section is talking about certain senior citizen. It talks about certain senior citizens. It does not cover all senior citizens. It says you must be a specified senior citizen. Okay. So what do I mean by specified senior citizen? You are a specified senior citizen. This definition is actually the key. Who is of the age 75 years or more at any time during the previous year, who is having income in the nature of pension and no other income except the income of the nature of interest received or receivable from any account maintained by such individual in this same specified bank in which he is receiving pension income. And this specified senior citizen, of course, we are only covering residents here. This specified senior citizen has furnished a declaration to the bank that this is what I want this section to apply. I am giving a declaration to you. The form and the form in which it is going to be submitted, this will be prescribed by CBDT. Now, you are covering this type of an individual. Somebody who is resident, somebody whose age is 75 years or more, and the nature of income is pension plus interest from such bank on any account. So it can be interest on savings account, it can be interest on fixed deposit account. If there is a recurring deposit going on, then it can be interest maintained on recurring deposit account. But apart from that, apart from this, there is no other income. Apart from these two incomes, this specified senior citizen is not earning any other income. Now, if the age is 75 years or more, what will be the basic exemption limit applicable? Resident person having 75 years or more का age. So, if you are up to 80 years, then your basic exemption limit will be 3 lakh rupees. Or if you are above 80 or above, then your basic exemption limit is going to be 5 lakhs. You are covering somebody who is 75 years or more. So the person can be 78, 79 years old. And in that case, the basic exemption limit will be 3 lakhs. Above 80, 5 lakhs. What is the provision saying? What is the section created for? It's a section introduced in the chapter of TDS. Now, so it says overriding the entire chapter of TDS. In case of a specified senior citizen, we just saw the meaning, the specified bank. Okay, so now there is a new term, specified bank. Who is a specified bank? Specified bank means a banking company as the central government will notify. The specified bank shall, after giving effect to the deduction allowable under Chapter 6A and rebate allowable under Section 87A, compute the total income of this specified senior citizen for the relevant year and deduct income tax on such total income on the basis of rates in force. So basically, TDS will be done according to slab rates. What does this mean? If I am talking of a specified senior citizen as defined in section number 194P. Now, if I am talking about a specified senior citizen like this person, his nature of income is he's earning pension income. He could be earning interest income on savings account, interest income on fixed deposit, interest income on recurring deposit. Take all those incomes. No other income. This person has no other income. This is going to be his gross total income. From this gross total income, the bank will deduct Chapter 6A deduction. Now, how will the bank come to know what is the Chapter 6A deduction? So see, one Chapter 6A deduction is very easy to understand. If you are a senior citizen who is 60 years or above and a resident, you are entitled to a deduction under Chapter 6A of Section 80 TTB. Let me make this a bit more easy for understanding. Pension income, A. Savings bank interest, B. FD interest, C. RD interest, D. So under Section 80 TTB, interest income from any account maintained with a bank and banking company is covered. subject to a maximum of 50,000 will be the deduction allowed. That means savings, FD, recurring deposit, everything is eligible. Maximum deduction permitted 50,000 rupees. Whichever is lower, this will be the chapter 6A deduction. Then you may remember that the specified senior citizen definition is that he is giving a declaration in this specified in a particular form. That means in that form, details about other deductions under chapter 6A will also be furnished. He could still have a life insurance premium. He could have maybe health insurance premium, so generally is not available at that age. Generally, health insurance companies don't give that give health insurance, but maybe if he has health insurance premium, if he has given a donation somewhere, any deduction under chapter 6A that is possible, which he will submit in that form, take that chapter 6A deduction and compute the total income. On the basis of this total income, the bank will do the computation, by the way, the bank will do this computation. Calculate your tax calculated according to slab rates, and we saw that the basic exemption limit of either 3 lakh rupees or 5 lakh rupees will apply depending on the age. You will be entitled to a rebate under section 87A. Maximum rebate possible is 12,500. And if you are somebody who is having income of up to 5 lakhs, only then the rebate applies, of course. Total income should be up to rupees 5 lakhs. But if you are someone who is 80 years or above, then anyways your tax is 0. So the question of having any rebate does not arise only. Add surcharge, add health education cess, and what you now get technically is your tax payable. And that specified bank is supposed to deduct this amount. TDS under section 194P is supposed to be this amount of TDS. Obviously, the final tax liability is going to be 0. This is the entire calculation. Have a glance. On the left side, I am talking about computation of income. And here on the right side, this is computation of tax. And this is the amount of TDS. And the entire amount of TDS is deducted. What do you mean by rates in force? Generally speaking, rates in force mean rates as per the relevant Finance Act. But now, here things will be calculated according to slab rates. The section says specified bank will do this computation, give chapter 6A deduction, give rebate, and then whatever tax remains, deduct that tax amount. So, somebody who is as old as 75 or above will benefit a lot. They don't have to go through the hassle of filing a return. The specified bank will do it on their behalf. And look at this citizen. This person is a specified senior citizen who is receiving pension income. And the section says that in the same bank account where he is receiving the pension income, he does not receive any other income. I am talking about this condition. Condition number 2. I am talking about this. He is receiving pension income from his employer, or he could be receiving pension income from any pension scheme that he would have purchased in the past, and now he's getting pension. But and that is deposited in the bank account maintained with this specified bank. But other than pension, the only income that he is getting is interest income. So the specified bank is definitely in the position to find out the total income. And once you give this declaration, giving such particulars as may be prescribed, Chapter 6A deduction information can be given. So, it is very much possible for the specified bank to do the computation and deduct the tax. And look at the relief given. The provisions of 139 shall not apply to this specified senior citizen for the relevant assessment year. In which tax has been deducted under subsection 1. Why should I tell the specified senior citizen to file a return? Whatever was the tax payable has been deducted by the specified bank. So there is no requirement of filing a return. Even if your gross total income is above the basic exemption limit, we will not ask you to file a return. We've already got the tax. So this is a provision that is going to benefit senior citizens. They are anyways way too old. Computation will be done by the bank. All that they have to do is to furnish a declaration. They should only be receiving pension income and interest income. From this, many students can think like this also. So, sir, that means if you are a senior citizen but below the age of 75, this section will not apply? Yes, this section will not apply. Then, sir, what will be TDS done? Then TDS will be done as per the chapter of TDS normally. 194P. When this section begins, it says subsection 1, notwithstanding anything contained in any provisions of this chapter. 194P overrides everything else. But that is only for a specified senior citizen, na yaar. So, if you are somebody who is below the age of 75 years, then even if you are a resident, 194P will not apply. That means what will happen? For you, TDS will be done normally. When the bank will give you, interest, it will deduct tax as per 194A. If you are getting pension, so on the pension, if TDS is to be deducted, the employer or that insurance company will deduct TDS. Then this section will not apply. Another example to think. Sir, what if this person is 75 or above, but is getting other incomes also? Like at the age of 77 years, he sells one of his property and he earns capital gains. 194P is not applicable. Who is having income only in the nature of pension and no other income except the income of the nature of interest received from account in the same bank. That means these are the only two incomes that you should earn for you to be covered under 194P. If you earn other interest incomes, if you have purchased debentures and you are earning interest, if you are selling your capital assets, then 194P will not apply. Then no relief in filing of return of income. TDS will be done by everyone as per the respective section. File a return, claim a refund if it's a refund situation, pay tax if it's tax payable, then you will be treated like a normal citizen only. So this section highlights, as it is very aptly saying, specified senior citizen. Only these selected persons are covered. And senior citizen ka meaning is also different. It's not 60 or above, it is 75 or above. So even if you are 60 or above, but less than 75, no relief. You will file a return, people will deduct tax as per the respective TDS sections. And you can have any other income also, then this section will not apply. So, a section for the benefit of senior citizens. Simple enough, can come up as MCQs also. Now coming to the last set of section, 194Q. First of all, let us read the section. Any person being a buyer. Now you're a buyer, which means from the TDS perspective, you are the payer of money. It's a TDS section. Just keep that in mind. Any person who is a buyer who is responsible to pay any sum to any resident hereafter in this section referred to as the seller. That means my seller is a resident person for purchase of any goods of the value exceeding 50 lakhs. Either it is a one-time transaction of purchase or aggregate multiple transactions exceeding 50 lakhs in any previous year shall at the time of credit of such sum to the account of the seller or at the time of payment. We already know this payment or credit, whichever is earlier funda. By any mode you make a payment or when you credit the account of the seller, deduct an amount equal to 0.1% of such sum exceeding 50 lakh rupees as income tax. Achha, so as of now, I can conclude TDS is equal to 0.1% of the sale value in excess of 50 lakh rupees. And what is going to be my sale value for this section to apply? My sale value is going to be exceeding 50 lakhs. Now, an explanation which explains many things, but at the same time creates a confusion also. And a confusion was created in the practical world when this section was introduced. What is this? What is it saying? For the purpose of this section, buyer means a person whose sales, gross receipts, or turnover from the business carried on by him exceeds 10 crore rupees in the immediately preceding financial year. That means a financial year in which the goods are purchased preceding that year. Not being a person as the central government may by notification in the official gazette specify for this purpose, subject to conditions specified. So, 1 minute, 194Q is what we are thinking, right? Chalo. Let us try and put down something on the screen. Just a second. Yeah. Section number 194Q. If you are a buyer who is purchasing goods from the seller, when you will make a payment, goods having a sale value in excess of 50 lakh rupees. Then when you will pay the sale amount, sale value minus TDS. And what is TDS? 0.1% of the sale value minus 50 lakhs. This much amount of tax will be deducted at source. Balance will be the net amount of check that we will release to the seller. Now for this provision to apply, the buyer should be someone whose turnover in the preceding financial year. That means, for my example, financial year 2021, we are talking about goods which are sold in the current year 21-22. So 1 year ago, the turnover exceeded 10 crores. Then the buyer is supposed to deduct 0.1% ka tax. Ab, if this was the only section, that was not a problem. TDS is generally done by the payer of money. Okay, when I am purchasing goods, I'm supposed to pay, and tax is deducted at source. There are TDS sections on interest, salary, commission, rent, professional fees, contractor payment. So might as well there can be a TDS section on goods ka purchase also. 1 year ago, Finance Act 2020 has introduced in the TCS section, tax collected at source. This is the amendment as per Finance Act 2020. 1 year ago, in 206C, this 1H was inserted. And what is 1H saying? Every person who is a seller who receives any amount as consideration for the sale of any goods exceeding 50 lakhs, certain goods are excluded. These all goods are excluded because, sorry, these are goods that are excluded because, number one, either we are talking about export of goods or we are talking about import of goods. So one of the two parties, seller or buyer, is outside India. Then we are not saying TCS will apply. If you are covered by 206C subsection 1, timber, minerals, tendu leaves, alcoholic liquor, there is already a section of TCS existing since years, almost 2 decades, I believe. Then you can't cover the same transaction again in TCS by 1H. Subsection 1 is already there. If you are covered by 206C 1F, motor car ka sale, then on that sale of motor car, on that retail sale of motor car, tax is always going to be collected under 1F. You cannot cover it under 1H. And if you are doing some remittance under 1G, so tax is being collected. These are all the exclusions. Exclusions from 206C 1H. Except for all these, if there are any goods, or if there are any goods sold by the seller, he will collect from the buyer a sum equal to 0.1%, exceeding 50 lakhs as income tax. This is the problem. You are introducing 194Q in the current year. What is this? This is Finance Act 2021 amendment. And the same government in 2020 has already introduced an amendment. Okay, this is way too light. 206C 1H, where as a seller, if you are selling goods to the buyer will have to pay to you TCS amount. If the sale value of your goods exceed 50 lakhs, then seller, you will take the sale value and you will have to collect TCS at 0.1% on the sale value which is in excess of 50 lakhs. And this is going to be the check amount for the seller. Here comes a problem. Look at this in its entirety. Last year, Finance Act 2020, it said, hey, you have to, as a seller, collect tax at 0.1%. Let me mention one more thing here. Seller means a person whose total sales, gross receipts, or turnover carried on by him exceed 10 crore rupees in the immediately preceding financial year in which the sale is carried out. 1 minute. Now, look at this. Seller has to be a person whose turnover in the preceding financial year. So let us talk with reference to our year only. Sale happened in 21-22. So turnover in 2021 should exceed 10 crores. If you independently analyze the sections, you will come across one example where there will be overlapping of both the sections. And this will create a genuine problem. What is the check amount that the buyer is supposed to do? If, for example, goods are sold for 70 lakhs minus 50 lakhs, 20 lakhs into 0.1%. I am not talking whether it is TDS or TCS. I am basically trying to show that confusion. 20 lakhs ka 0.1% will be 2000. 20 lakhs, 2 lakhs, 20,000. 20,000 will be 1%, I think. 2000, I think. This is what the problem is. Should the buyer, it's 2000. What should the buyer do? Should the buyer pay this additional 2000 rupees in the form of TCS? 70 lakh plus 2000? Or should the buyer, as per the new section, say 70 lakh minus 2000? This will be the problem when the two sections overlap. Sir, how will they overlap? Look at the definition of buyer and look at the definition of seller. Buyer is somebody whose turnover in the preceding year exceeded 10 crore. Seller is also somebody whose turnover in the preceding year exceeded 10 crore. And the sale value today is more than 50 lakhs. So if a seller whose turnover last year exceeded 10 crores is selling goods to a buyer whose turnover last year was also more than 10 crores and the sale value today is more than 50 lakhs, seller will claim that he is required to collect tax at source. Buyer will claim that he is required to deduct tax at source. So ultimately, what needs to be done? Should you do TDS? Should you do TCS? It is somewhat illogical. Why did the government come out with this provision? I mean, last year they had already covered these type of transactions from the seller's perspective. So there was a TCS inflow. Then what was the point of introducing another section of TDS? Maybe we can probably figure out maybe the reason once we look at the entire section. 194Q, the amendment that has been introduced. Let us complete the reading of the section. This is our section 194Q. We've just read subsection 1. Subsection 2, nothing great. If you record anything instead of the seller account in the form of a suspense account, then also the section of TDS will apply. This is a paragraph which you will find in many sections of TDS. If any difficulty arises, the board will come out with guidelines for this. Every guideline should be laid before each House of Parliament. There are many sections introduced in Finance Act 2021 which have this type of drafting. Subsection 5. Now this probably will make things, probably will help us. The provisions of this section shall not apply to a transaction on which tax is deductible under any other provision of this act. 194Q का TDS section will not apply if there is any other section of TDS that is applicable. Fair enough, you can't have two separate TDS sections simultaneously becoming applicable. Like we have 194C, contractor payments. And it says that if you manufacture goods according to the requirement of the customer, then the customer, when he makes a payment, he will deduct tax. He will deduct your tax under 194C. So, but obviously, if 194C will apply, to 194Q cannot apply. Point 2. Tax is collectible. The provisions of this section shall not apply to a transaction where tax is collectible under the provisions of 206C. Other than, as if the confusion was not enough, so this extra confusion has been introduced. Other than, sorry, way too bad color choice. Yeah, maybe. Other than, this is even horrible, sorry. Other than a transaction to which one edge applies. एक minute. 194Q will not apply if tax is collectible under 206C. But 206C other than 1H. Okay, let us first of all try to simplify this. TCS is done under 206C subsection 1. Then TDS under the new section 194Q. If the seller sells liquor, timber, tendu leaves, mineral, then the seller will collect tax under 206C subsection 1. So TDS will not apply. If the seller sells motor vehicle, I'm sorry, not motor car, motor vehicle, 1F is applicable. So if tax is collectible under 206C, 194Q will not apply. If 206C, 1G applies, then 194Q is not applicable. But what did 194Q say? The provisions of this section shall not apply to any transaction where tax is collectible under 206C other than a transaction where 1H applies. So if 206C 1H applies, then 194Q will also apply. And precisely that is what our confusion right now is. This subsection is not this subsection is not solving our confusion. It is just confirming that yes, this can be a confusion. 194Q, the provisions of this section shall not apply if tax is collectible under 206C. But if tax is collectible under 206C 1H, then that type of transaction is excluded from point B. That means tax will be collected under 1H and TDS will be done under 194Q. 1 minute. Again, it's the same concept of overlapping. Then when you look at 206C 1H, the second proviso helps you understand. 206C 1H will not apply if the buyer is liable to deduct tax at source under any other provision of this act on the goods purchased by him from the seller and has deducted such amount. In 1H, they have written that if the buyer is supposed to do TDS, then the seller, you are not supposed to collect tax. So in a case of overlap, in this case of overlap, 194Q will prevail and 206C 1H will not apply. See, seller, buyer, turnover of the seller greater than 10 crores, but turnover of the buyer less than 10 crores. Now, if the turnover of the buyer is below 10 crores, 194Q not applicable, but 206C 1H yes will apply. If the turnover of the seller is below 10 crores, but the buyer's turnover is about 10 crores. Now 194Q will apply and the TCS provision will not apply. Suppose turnover of the seller in the preceding year exceeded 10 crore. Turnover of the buyer also exceeded 10 crore. Then both the sections became applicable. (194Q) as well and TCS as well. So the final conclusion here will be 194Q will apply because the proviso in 206C says if TDS is deducted on this transaction, seller you will not collect tax. This is the overlapping. Let me mention one thing for clarity. This entire discussion that I have put up on the screen. Just a second. This comparative table that I have put up on the screen. This table is prepared under an assumption that the sale value of the goods exceeds 50 lakhs. Only then, of course, the provisions of both TDS and TCS are getting triggered. Na? So that is an assumption that I have made while I have prepared this table. Now, because these two sections are there, 194Q and 206C1H, it's a section of TDS, it's a section of TCS. Luckily, the lawmakers have also thought of non-furnishing of permanent account number. If that happens, then what to do? So see, 206AA. If you do not furnish permanent account number, and we are talking about tax deducted at source, and the section that we are talking of is the new section 194Q. 194Q. Then instead of 20%, it will be 5% ka TDS. So 0.1% as given in the section, or 20% nahi, it's going to be 5%, whichever is higher. Tax to be collected at source. Tax to be deducted at source. Similarly, in 206 CC, twice the rate, 0.1 into 2, 0.2% or 5%, whichever is higher, for tax collection. If you don't submit your permanent account number, TCS will be collected. There is no amendment here. For clarity, at the end, see, I've prepared this table where there is a combined application of both the sections. Just give me a minute. Turnover of the seller in the immediately preceding financial year, 18 crores. 1 minute. So it is about 10 crore seller. So 206C1H will come into play. But the turnover of the buyer was only 2 crores. So 194Q does not come into picture. Sale value 59 lakhs. Permanent account number is available. So 1H will come into play. 0.1% of that excess 9 lakhs. Example 2, same data, 18 crore, 2 crore, 59 lakhs, but permanent account number is not available. Twice the rate or 5%. Now instead of 0.1, it will be 5%. 5% of the excess. So it will still be TCS, but 45,000 ka TCS. Example 3, turnover of the seller is below 10 crores, but turnover of the buyer is above 10 crore in the preceding year. Now I talk of 194Q. Goods are sold worth 60 lakhs. Permanent account number is given. So TDS will be done 194Q, 0.1% of that 10 lakhs. Serial number 4, same facts, but without permanent account number. So in 194Q, 20 nahi, 5%. So 0.1 or 5%, whichever is higher, 5% of that excess 10 lakhs. 50,000 ka tax will be deducted. What used to be just 1,000 rupees has become 50,000. And now comes the overlap example. Turnover of the seller above 1 crore, about 10 crore. So 206C1H. Turnover of the buyer is also above 10 crore. 194Q. Sale value is above 50 lakhs. Permanent account number is available. If overlapping happens, 194Q will apply. As per the second proviso to section 206C1H, TDS under 194Q shall prevail. 0.1% of that 30 lakhs. Same facts on the next page. 12 crore. So 206C1H will apply. 15 crores. So 194Q will apply. But permanent account number is not there. But ultimately what will prevail? 194Q will prevail. And so if permanent account number is not there, 206AA will come into play. 206AA comes into play, which says 5% or 0.1 original rate or 5%, whichever is higher. TDS will be done. The TDS, which was only in the previous example 3,000 bucks, has now grown to 15,000 rupees, 5 times. It's a clear jump. 0.1 instead of 0.1, it has become 5%. Actually, not even 5 times. It is more. Seventh one, any amount of sale, any amount of turnover of the seller, any amount of turnover of the buyer. But beta, if the sale value is below 50 lakhs or up to 50 lakhs, now the moment you are selling goods, purchasing goods, but it's up to 50 lakhs only, then 206C 1H is not applicable. 194Q also is not applicable. There is no need to do TDS or TCS. I'll just mention one thing here. We are aware about this one fact. If the goods are covered by 206C 1 or 1F or 1G, then there is no threshold of turnover prescribed for the seller or for the buyer. Nothing of that is prescribed. Then, yes, TCS will apply, but TCS will apply as per subsection 1, 1F or 1G. The conflict that we are thinking of 194Q and 1H will not arise because the sale value is up to 50 lakhs only. There is no conflict. There's no conflict only. Then if a specific TCS provision is applicable, then definitely yes, that specific TCS provision will apply. So I've just put up the Google Drive link again in the chat box. So anybody wanting to take down these notes, you can download it very easily. If you have any doubts, you can put up the doubts in this video as well as in the chat. You can put up the doubt. I'll also give you my email ID. For any doubts, you can just send a mail to me and I'll give you the answer through the mail. So these are the significant important amendments in TDS TCS that Finance Act 2021 has introduced. Hope this lecture was useful to you. Hope you guys study well. Chalo. Goodbye. Happy studying. Tada.